Make better money choices. Choose a bank that takes your money seriously. Business Watch is brought to you by Nedbank.
Very good afternoon to you. It's 2 p.m. Central African time on this very good Wednesday afternoon, the 18th of September. A very insightful program that we have to you. My name is Fiso Ngumalo. Very pleased to be your host once again today. I'm not alone. I'm with Lungalele. Good afternoon to you.
Afternoon, Fiso. How are you this afternoon?
I'm fantastic.
I'm great.
Do you know what? I was just looking at the lineup for the show today. Pretty much the agenda is speaking to the development, our business development, and that's pretty much what this show is about. Coming up, the Minister of Finance draws a firm line that is declaring the government will not allow the debt to GDP ratio to surpass 40%. But with the hefty 2 billion Malangeni loan from the Mkonvo Ngwavuma augmentation program, can we really avoid that threshold? That's the biggest question. Concerns about national debt grow. We'll be joined by our residential financial expert, Sanele Sibia. We want to dissect the implications. Is this loan a necessary risk for infrastructural progress, or are we teetering on a fiscal cliff? Stay with us for critical insights you won't want to miss.
Yeah, good afternoon once again. Today we are delving deep into Nedbank's investment solutions. The topic of investing has the power to transform lives and secure futures. In an economy where financial stability is increasingly crucial, understanding how to make informed investment decisions is not just a skill, it is a necessity. As Nedbank's slogan suggests, they use their financial expertise to do good. This includes encouraging conversations about taking money seriously. Nozibu Siso Demi will join us later on the program to unpack some of the key things to consider when saving and investing. And later on our last segment, Sandy Swadlamini will give us an analysis for today's financial markets. For now, let's head straight to business news. It's 2 minutes after 2. You're still tuned into Nedbank Business Watch. Let's go straight to the news.
On our first story, the Eswatini Revenue Service collected 6.2 billion emalangeni this year on their online platform e-tax system. Now, this was shared by the Minister for Finance, Honorable Neil Reichenberg, when launching the tax filing season. This was at the Eswatini Revenue Service headquarters, Ezulwini, where he also encouraged that all taxpayers should pay their taxes on time.
The theme for this year's filing season, Stay Compliant, Stay Ahead, is more than just a reminder. It's a call to action. By staying compliant with tax obligations, not only do you avoid penalties, but you also take control of your financial health and position yourself for future success. Timely compliance ensures the smooth running of your business, supports efficient financial management, and most importantly, contributes to the overall well-being of Eswatini's economy. Your commitment is key in keeping our nation moving forward. As we enter the tax season, I'd like to highlight the key deadlines that all taxpayers must keep in mind. The first one is the 30th of September. Employers are required to submit the annual PAYE reconciliation and make the necessary payments. The next one is the 31st of October. Businesses must file and settle their tax obligations. The next one is the 30th of November. Individuals, and particularly high net worth individuals, professionals, and those with multiple income streams must file their returns and make payments. This one is referred to personal income tax. These deadlines are not mere formalities, but essential obligations. By adhering to them, you not only ensure your compliance and avoid penalties, but also contribute positively to our collective economic goals. I'm also happy to share with you a significant milestone in our efforts to modernize and simplify tax processes, the introduction of Tax Ease. Launched in March 2024, this digital platform is designed to make tax filing easier, faster, and more secure for everyone. Whether you're at home, at the office, or on the go, Tax Ease offers the convenience of filing from anywhere. This year marks the first time that income tax returns will be filed through Tax Ease. I'm pleased to report that over 7,500 accounts have already been registered. With this ability to link multiple tax identification numbers, what referred to as TINs, to a single account, Tax Ease offers flexibility for individuals and businesses alike, with some users managing up to 20 TINs. We have also seen an encouraging uptake, with the 8,124 taxpayers having filed their returns online through Tax Ease. As of the 12th of September, 54,842 tax returns, which are made up of 38,900 from PAYE, 11,466 from VAT, 368 from company income tax, and 3,108 from personal income tax. All of these have been processed on the platform, a testament to the growing trust in the system. Moreover, I'm proud to announce that ERS has achieved an impressive year-to-date revenue collection of 6.02 billion emalangeni, which is a 13% increase compared to last year's performance under the legacy e-tax system.
16 people are currently being audited for lifestyle by the Eswatini Revenue Service. This was revealed by the Commissioner of Domestic Taxes, Vusi Nkampalala, during the launch of the tax filing season at the Eswatini Revenue Service at Eswatini.
It is relevant and important now that we are calling for income tax returns to encourage all those people who are supposed to file their returns to declare correctly, because we look at the declarations and take it from there. Our approach then, as I said, we don't appear every day in the paper having taken people to jail for tax evasion, even businesses, whereas for individuals. So it takes time. We have 16 individuals that are undergoing lifestyle audits currently. And I must state that it is not a fast or quick audit like it is for companies, because you'll understand that if I am dealing with an individual, it depends on his availability.
On another note, the service says although there has been a slight increase in VAT tax compliance, there is still a significant number of businesses that do not pay VAT tax.
We have seen improvements, although as the CGS said, we still have gaps, but we have seen revenue from VAT increase by about 9% compared to last year. And as we speak today, it's the fastest growing of all the tax types that we have. And for the first time, we're ranging above the target by 2%, which means there have been significant improvements. And it's the most performing tax type for us. And speaking to the voluntary compliance that the CG talked about, we've also seen an increase of about 2% to the rate of voluntary compliance on the VAT side to about 70%. So we are seeing improvements, but there are still huge gaps that we are working on.
The Commissioner General of the Eswatini Revenue Service, Brightwell Nkampule, says different initiatives are being put in place to further increase tax compliance.
The system that we introduced recently has significantly improved our performance on VAT. Now, this system allows our taxpayers to file details of their VAT input-output. So with the detail, the invoices, basically all the invoices that they issue out are expected to be filed. The invoices that are in the payments that they make are expected to be filed. So that enables us to now cross-check to see who has paid who on VAT. So that has somewhat had a very positive impact on the performance as VAT.
The Eswatini Revenue Service urges businesses to comply with the tax laws this filing season, saying different programs are in place to assist those who will have challenges as they file their taxes. For Nedbank Business Watch, Nelson Dlangamandla, Vuminkosi Nzinisa, Ezulwini.
It's 10 minutes after 2, and that's it for our business news. Thank you for tuning in. This is Nedbank Business Watch.
Yeah, we'll be right back after the break. We connect with Sanela Sbia virtually to speak to the debt to GDP ratio, pretty much the public debt. Don't go anywhere. Welcome back to the program. You're still watching Business Watch, the Nedbank edition this Wednesday. We want to get into a very interesting segment right now where the Minister for Finance says there is no way that the government will allow the debt to gross domestic product ratio to be above 40%. That is against the recommendations of international monetary organizations. Now, the Minister was responding to a question of concern that the 2 billion emalangeni from Mkhonvo Ngwavuma Augmentation Program loan is going to push the debt to GDP ratio above the recommended 40%. Let's take a look.
Parliament recently approved the Mkhonvo Ngwavuma loan, and economists are saying the debt to GDP ratio will grow to 43% with the approval of the loan. They are saying this will put the country in financial instability. The Minister of Finance, Neil Rickenback, says the nation has nothing to worry about.
The mistake people make is, let us just say we raise a loan and have a loan pass through Parliament. Let's just say building the dam, the Mkhonto Mpangeni Dam is the one that's now being built for 2.6 billion, if I recall. We need to keep in mind that we only recognize the loan on our debt when we draw down the loan. So that dam is going to take another 4 years to build that dam. So it's over the 4 years that as we draw down the loan, as we are paying the contractor, do we recognize the debt on our stock of debt. At the same time, over the next 4 years, we are repaying probably 10 billion eMalangenis worth of debt because there's constant debt repayment. Huge loans that we took during COVID are being repaid now, and they finish being repaid next year. For instance, aggressively repaying almost 250 million a quarter on one of these debts. And so what I'm saying is one needs to look at debt not when we raise the debt, but as you draw down the debt. And when we model it that way, we are definitely running our models to make sure at the moment that we stay below 40% debt to GDP ratio. We're committing, even with the loans that we are taking, and we're going to come with more loans. But as we're taking these loans, we're repaying loans, we're managing that process very well, and we're going to do everything we can to remain below 40% debt to GDP, and in time take it down to 30% or 35% that I was talking about earlier, which will really make sure that in case we have SACU pain, we can absorb the SACU pain in that process.
The International Monetary Fund says if a country has a high debt to GDP ratio of more than 40%, it is less likely to be able to service its debts, and this will cause financial panic in domestic and international markets. For Nedbank Business Watch, Nelson Dlangamandla, Vuminkosi Nzinisa, Ezulwini.
Very, very interesting development there, but perhaps maybe a quick recap before we welcome Sanela Sbia, who has already joined us virtually. This is in light of the growing concerns that are surrounding our national debt. The latest statement from Minister of Finance, Neil Rickenback, who we have just listened to, has reignited a critical conversation. The minister, as we have heard, has assured the nation that government indeed will not allow the debt to GDP ratio to exceed 40%. And this is despite international recommendations. In a short assurance that comes as concerns mount over the 2 billion emalangeni loan for the Mkonvo Ngwavuma augmentation program. Many questions. What does this mean for Eswatini's financial stability? Are we walking a tightrope when it comes to balancing debt with essential infrastructural development? Sanele Sbia is here. He's going to unpack all these essentials with us. Sanele, very good afternoon to you. Quite a lot of imperatives here, an interesting development indeed. He has been emphatic, the Honourable Minister, that is, about keeping the debt to GDP ratio under 40%. From a financial standpoint, how realistic is this, considering the scale maybe of the Mkonvo Ngwavuma augmentation program?
Thank you, Mr. Ngumalo. Thank you for having me, and good afternoon to the viewers at home. So what we are seeing here, I mean, it's a bit comforting what the minister is saying, but what we are seeing in this case is the fact that, government has already been approved, the parliament has already approved that the minister should go to the JSE and raise to upwards of 4 billion, and it's only drawn 400 million of that money. So there's essentially a, if I would put it this way, the minister essentially has a what's it called, a blank check to the tune of 3.5 billion in Malangani right now, that he would go and have it and take and raise that money without necessarily going through parliament again. And now there is this other 3 billion again that is coming out, this 2.6 billion that's being raised for the construction of the dam. So that's the major concern that we have as economists, to say, you've already been given approval for these monies, and that's the money that you can go and raise anytime without going through parliament. So what we are worried about right now, it's an issue of balances and controls in terms of who now is going to control how the minister draws down on these monies, more especially the JSE money. I think that's where we have a lot of a problem with as economists. And then coming to the scale of the Mkonvo Ngwavuma dam, like you're rightly putting it, it's going to be a huge scale project, and you might find that as it runs through time, you find that the requirements also get to skyrocket, and you find that we need more than the 2 billion to complete the dam. So there might be even more money required therein to complete that project. But what we are seeing is, if the minister is actually going to be able to ensure that he balances, new debt with old debt, then we are going to be in a position to stay within the 40%. And also, if we can attain the 5% growth target, then that means we'll be moving, the denominator will be moving to a higher growth level. And then that means overall, when you look at it in the bigger scheme of things, the debt to GDP ratio would then have to start coming down. And, that would mean we have a better potential to pay back those loans. So that's what we are, that's where we would be thinking about it, Mr. Ngumalo. Otherwise, I think what the nation needs is to ensure that we have continued controls over how much, more especially on the JSE loan or the JSE bond, that the minister can raise, given that, there is no monies that are coming in on board.
It's quite interesting because you speak of the inevitable, perhaps costs that they may not have on paper right now. It makes me really, really concerned, but perhaps they have a way around it. But I also want you to chime in into, perhaps with your expert opinion, how the debt to GDP ratio of 40% compares with international standards, and perhaps why you think Eswatini's position differs from the recommendations of the IMF as well as other financial bodies.
Thank you, Mr. Ngumalo. I think for me, that's the worrying thing, because when you look at the way we're performing relatively in the region, I think we're amongst the best. Most countries in the region are actually above the 40%, and most developing economies are actually above that 40%. But when you look at the configuration of our economy, this is a good practice that we must maintain, purely because our fiscal press is largely dependent on the Southern African SACCO revenue receipts, and we know how volatile those are. We know that the minister is trying to set up a SACCO stabilization fund, because we know that that source of revenue for the country is very much volatile. You might wake up tomorrow, the formula is changed. We are not getting the same amount that we are getting. So that's why we are always constantly worried about the debt to GDP ratio as a country, because our fiscal fortunes are largely dependent on trade and the regulations and the configuration of SACCO in itself. So that's what worries us. And that's why we always, as a country, cannot afford to take a lackluster or a relaxed type of approach and say, but we're doing comparatively better compared to our neighboring or our comparator countries. But our circumstances are different. We are not a resource-based economy where we're going to say we are going to mine and always ensure that the money is there. We are going to be able to pay. We don't have that luxury as a country. So we cannot afford to actually go above this threshold. I mean, if you recall back to 2010, where SACCO receipts actually fell drastically, you remember what happened in the country. We really struggled to keep the cash flow situation, and we really struggled to pay even for the basics, because if you have a huge chunk of your fiscal expenditures going towards debt repayment, then that means you have nothing. You are left with virtually nothing to spend on your social programs, infrastructure programs, and quite other programs in the country. So that is why, as a country, as economists, we always urge that government should stay within that threshold, so that at least we are able to pay for our external debts, for our public debts, utilizing the revenues that we are collecting domestically. Though at that time, should we face that time, then we should see social spending suffer quite much. So that is why, as a country, we must walk a tightrope, ensuring that we balance our growth trajectory, both our debt and our social expenditures, because our economy really benefits much from trade, and that's a very volatile stream of income.
Absolutely. No time to be complacent. I would love to, have a conversation about how this sits when juxtaposed with the recent government policy statement, because that also spoke to a lot of ambitious programs, which I suppose could really help with this ambition of the debt to GDP ratio. But perhaps that's a topic for another day. That's going to require at least 30 to an hour. I want us to talk about, given that the 2 billion Malangani loan is earmarked for an infrastructural program, I would have loved to know how you think the government will balance this with its commitment to keeping the debt under control. But perhaps let's just move to another interesting question. If the debt to GDP ratio were to exceed 40%, Zanele, what tangible economic risks could Eswatini face? Are we looking at potential downgrades from rating agencies, or could there be consequences that are more subtle?
In terms of the rating agencies, we would actually get a bit of a backlash on that side. So that's a given. But what we really worry about, because when you talk of managing debt and when you talk of the debt to GDP ratio, the most important thing here is the ability to pay. And when you talk of money, if you have this pot of money, it's the very same pot of money that needs to go towards the social expenditures and other expenditures in the economy aimed at growing the economy. So that's what we always worry about. You always need to ensure that you have enough money to continue social expenditures and to continue other critical programs in the country. So if with that debt to GDP ratio were to go way above that point, then that means as a country we would begin struggling to actually pay other initiatives. That means a lot of the revenues that we collect through ERS and quite other other government revenue streams, that money would purely go towards settling debts. And that means at that point in time, we would have very little to maneuver around in terms of pushing other programs, and more especially social expenditure. So that's the most worrying for us in terms of the social expenditure, and ensuring that we are able to push forward and make sure that we are able to continue providing for our people, while at the same time we are able to ensure that we pay our debts on time. And Eswatini has a very good record on that in terms of debt repayment. We've never defaulted, even when we were supposed to default back in 2010, but we really just performed well and we continued paying our debts. So that's a record that makes us a very astute borrower, and we become lucrative and very easy to deal with in terms of the eyes of the financiers. But we need to ensure that we're able to keep that under control. That is why when we are seeing a situation where there's a potential control risk right now, because the risk right now that we are seeing is actually a control risk. the parliament is there to control the actions of the minister. But right now, if the minister has already approved for 4 billion and has only drawn 4 billion from the JSE, and now there is this 2 billion coming again. So that means now if we want to draw more money from the JSE, the minister does not actually need to go through parliament. So it's more an issue of controls right now. That's the major risk that we are seeing, a control risk. Who now controls? So a lot of it is now left to the discretion of the minister. So that's what we are a bit worried about. It's comforting, the fact that for me, I think he would rank second only to the former PM Barnabas during his tenure as finance minister in terms of getting the country in the right direction. But right now we are leaving a lot of things to discretion, without the rules that are supposed to be there and guiding how the minister is going to take that money. So purely everything now lies on the discretion of the minister on how he's going to execute and how he's going to draw down on the 3.5 billion that he can still raise from the JSE. But it's comforting that, from his tenure, we've seen quite how we've seen a lot in terms of his character and in terms of how well he actually and how well he can actually manage the economy. But a control risk is always the control risk, no matter the integrity, no matter a lot of things, because things can just happen tomorrow that might force him to go and take that money. And now he would have to go without going through parliament. That's the main risk at the present moment, Mr. Nxumalo. But in terms of our debt repayment as a country, we've always been good. Now the problem is if the debt balloons above the 40% and then SACU cuts down, then we are going to have serious repercussions, and we are going to have a tough time paying our obligations and also ensuring that we are able to spend.
Sanele, I love cutting you. I really regret, Sanele, I regret cutting you, but perhaps because I've cut you, a simple yes or no answer, I'm sensing that you are optimistic about the fact that we shouldn't be concerned. They have it under control. Yes or no?
Komsa.
Okay.
Like I'm saying,
let's be our economist. Suddenly we don't have time. I'm really sorry, we don't have time. Suddenly let's be our economist chimed in on the latest concerns surrounding our national debt. Let's go for a net break. We'll be back shortly.
Digital helps you make cross-border payments. Human gives you global specialists. Digital allows you to apply for a loan anytime, anywhere. Human connects you to credit experts. Digital puts you in control of your money, while Human connects you to wealth advisors. Digital allows you to freeze, unfreeze, cancel, and reorder your card. Human gives you that personal touch. Digital when you want it. Human when you need it. Get the complete private banking experience with Nedbank Private Clients.
Welcome back. You're still watching Nedbank Business Watch. Thank you for staying with us. Today I'm joined by Treasury Dealer at Nedbank Eswatini, Nozibusiso Teme. She's here to talk about Nedbank Investment Solutions. A very good afternoon. Welcome back.
Thank you so much, Lulu. It's been a while.
So today we're talking about investments. Why should we invest? Why is this topic important to talk about?
So, Lulu, the topic of investing is so important because it literally has the potential to transform lives and to secure futures. And in an economy where financial stability is so crucial, it's not just a skill, it's really a necessity. At Nedbank, our slogan is to use our financial expertise to do good. And part of that is encouraging every Liswati to have a regular conversation about how to invest, how to save, and how to take money seriously.
All right. So the last time you were here, I think it was 3 months ago. I think it was May this year. You took us through some of the investments solutions or options that Nedbank Eswatini offers. So what are we talking about today specifically?
So today we'll be unpacking some of the things to consider before saving and investing. But I think because it was so long ago when I was here, it's really important for us to just do a quick recap on some of the Nedbank products that we spoke about last time. So I'll start with our shorter term products, which is our savings account and our call account. These accounts have a variable interest rate, which means whenever there are changes in Eswatini Prime, whether upwards or downward, the interest rate on that account reprices, right? Then we have our notice deposit accounts, which are available in 32 days, 60 days, and 88 days notice. And that account also has a variable interest rate. It has funds that are available after the notice period has lapsed. So if you have a 32-day notice, for example, in order to withdraw those funds, you need to give 32 days notice, and then you'll receive them after 32 days. And then also it has a top-up option. So all the accounts I've mentioned all also have a top-up option. So if you are trying to accumulate funds, you can keep adding as and when you have money. Yeah. We also have our fixed deposit. That one has a fixed interest rate. The tenor is also fixed, and it has no top-up option. So you would ideally put a lump sum in a fixed deposit account. We have our floating rate term deposit accounts. A floating rate term deposit also has a fixed tenor, but the difference there is that the rate is floating and it's linked to Eswatini Prime. So when there are changes in Prime, the rate on that account also changes accordingly. Okay. And then lastly, we have our negotiable certificate of deposit, which is a new product to Nedbank, a first in the market product. And with that one, you have a fixed interest rate, you have a fixed tenor. You also can't top up, so you can't keep adding funds into that account, but it has a buyback option. So if you have a 12-month NCD, for example, because in short it's an NCD, and then before the 12-month lapses, you run into an issue where you need those funds. You can then sell that that instrument back to the bank and get the money in return for that.
Right. So Nozi, what does one need to consider, before making an investment decision? Because I know some of us, if not a lot of us, are in the dark. We've always heard people advising us to invest your money. Do I need to be financially stable? What do I need to consider?
So Lulu, there's a lot to consider when it comes to investing, but I think just for the purpose of this conversation, we'll be covering four things. The first is understanding your needs and what you are trying to achieve. The second is understanding the interest rate environment that you're currently in and what the expected interest rate environment is for the future. Yeah. The third is risk management. And then the last is diversification, which is a risk management technique.
So why is it important for a person to understand their needs? For instance, a pensioner, take us through the importance of understanding exactly why investment is important and what your needs are.
Okay, so it's very important to understand what your needs are and what you're trying to achieve, because that then leads you to understand what your investment strategy will be and what kind of product to select in order to achieve what you're trying to achieve. Yeah. So you mentioned a pensioner, and that's a good example, because let's say you have received a lump sum payout of sorts. It doesn't necessarily have to be a pensioner, but we'll use that as an example for now. So with a pensioner, you know that this is your last payout for probably the rest of your life. You need to make sure that it lasts for as long as possible, because it's the money you're going to have to live on from now on. Which means you do desire a good interest rate. You probably want to invest the lump sum and maybe receive interest payments and live off the interest in order just to make sure you always have money available in your lump sum collection. Okay. But more importantly, you want to make sure that that money is kept safe. So you've spent the past 30, 40 years, however long you've been working, you've reached 60, you retired, you received your payout. This is money you've been saving for all those years. So basically, you have been investing in your future. And you need to make sure that wherever you then invest those funds, you are comfortable that they are safe and you will always have access to them when you need them. So if you are a Nedbank client, for example, and you are a pensioner, I would likely suggest to you a fixed deposit. Our fixed deposits pay interest either at maturity or monthly, quarterly, half yearly, or yearly. So if you invest for 2 years, you can still get a yearly payment of interest. But mostly pensioners prefer our monthly payments because then they can live off that interest for the rest of their lives, and the capital is secured.
Yeah, speaking of interest, let's talk about the interest rates. Why is it important to understand the interest rate environment and how it affects your investment decisions?
So that one is very crucial, Lulu, because interest rate environments directly affect what interest rates we will quote you as a bank. And you need to understand where you are right now and what the future interest rate environment might look like. And to just drive this point, I'll use the scenario of the time of COVID-19. So from the beginning up until just after COVID, as the economy was recovering. So in 2020, COVID-19 starts, and you might remember that during that time, the Monetary Policy Consultative Committee, which in short is MPCC, started to reduce interest rates to sort of cushion the impact on the consumer. And while the consumer was enjoying that, the investor was losing out on some interest due to that. And you then as an investor need to understand that and understand what the expectation is. So at the beginning of that cycle, economists were already projecting that we are in a downward interest rate cycle, right? So if you know that projection at the beginning, then when you make your investment, you know you're looking for something that has a fixed rate, so that you can fix the high rate before rates go down for whatever period. So it could be 12 months, we have 12-month fixed deposits, we have 24-month fixed deposits, and then you're stuck at that rate that we agreed at inception, even when interest rates are going down months later. And you need to understand that so you can pick the right product for yourself. Then we go into 2021. 2021 interest rates were muted. But muted at the low level that they ended 2020 at. And that happened throughout the year. So if you had invested at the beginning of the upward cycle in 2020, if you had invested in a fixed deposit for 2 years, during that 2021 period where interest rates are just at a consistent low level, you would have still been enjoying a high interest rate up until that fixed deposit matures. So you need to understand those things too. Then going into 2022, interest rates start to increase, right? Economists also did project that there would be an interest rate increase in 2022. So they start to increase up to the levels that we're at now. And if you are an investor at the time, so at the bottom of that curve, and you want to invest, you don't want to lock your funds in an instrument that has a fixed rate, because you are fixing a rate at the low levels that we're at. You would rather invest in an instrument that has a floating rate, so that as interest rates are increasing slowly, you are also moving up with the interest rate. So if the floating rate is linked to Eswatini Prime, whenever Prime increases, your deposit or your investment also increases. So it's important to understand what the interest rates look like at the time. And at Nedbank, we are always willing to share with our clients what our interest rate expectations are. You can contact your banker, you can contact us in Treasury directly, and we think it's important to share that information with our clients so that they can make wise investment decisions.
So that's one of the ways to effectively manage risks, because obviously, investing comes with risks.
Absolutely, that is one of the ways to manage interest rate risk. And our forecasts, by the way, I need to disclaim this. A forecast is just a forecast. We forecast what the expectation is based on what is happening right now. So there is a chance that in future that forecast will change, but it's important to at least know what's happening now when you have to make that decision.
All right, just before I let you go, we have a minute. Tell us more about diversification before you get into your contact details and how your clients can reach you.
Okay, so diversification is a form or a technique of risk management because we know how important it is to manage risk, especially when we're talking about money. There is a balance between risk and reward that we have to manage because not everything that glitters is gold. So we do have to manage that risk and reward. And diversification is a way of managing that. So if you have money, a lump sum payout that you want to invest somewhere, what would be ideal is as you are exploring the universe of investments, you take portions of that money and you put them in different investment avenues. And in fact, it would be best for you to put them in investment avenues that have different risk portfolios or risk profiles even, so that if it happens that one of your riskier investments falls through, you at least have something to rely on going forward.
Okay, great. So how do your clients reach in case they have more questions more than this?
You can reach us at help desk. You can call our help desk on 3278 1999, or you can call us directly at Treasury on 3278 1145 or 3278 1325. We also have a group email address, Treasury Eswatini @nedbank.co.sz.
All right, thank you, Zibu. Well, there you have it. If you want to invest, do not hesitate to contact Nedbank Eswatini. Let's take a break. Sabia Konamaj.
Welcome back. Thank you for staying with us here on Nedbank Business Watch. Let's continue with the program. Cultural sensitivity as well as inclusive language are some of the key elements that are needed in digital marketing. This is advice that was shared by Ngosivile Mamba, who is the digital marketing specialist from Omnimedia Group Advertising that is in Manzini. He was highlighting key focal points for successful digital advertising for entrepreneurs as well as small and medium enterprises holders. Let's listen to the rest of the conversation Ngosivile had with our very capable business journalist, Nelsiwe Ndlangamandla.
Ngosivile, welcome to the show. I can tell by your posture that you are ready for this interview. Please tell us about digital marketing. Why is it important, especially for small and medium enterprises?
I truly believe digital marketing is integral and important simply because of the ease of entrance, and there's not necessarily a barrier that is limiting, specifically in this instance, small and medium enterprises. The barrier for entry is low. Practically, you can actually go as far as saying it's free, simply because the resources that you need are at your disposal. It is thus integral simply because this is how you get your product out there, your service out there. You are in control as an SME as well. You don't necessarily need a budget, but you do obviously have an appreciation, or need to have an appreciation of a budget of sorts. So I truly believe that people should not necessarily look at it as a separate entity, because usually, people kind of perceive it as digital marketing as another type of marketing. It should be looked at as it is now how marketing is done, and now it is no longer limited to large corporations that have large budgets to get a large audience. You can create your own platforms and start selling. It's the main thing is just to start. So yeah, it's a must-have.
You are saying that it is free. We know that some young people complain about not having data, but would you say this is the cheapest way to advertise?
Okay, obviously usage will then vary. I cannot give a blanket statement on how much data you would need, but I guess ideally, depending on the platform you're going to jump onto, and I think also it's important to have a distinction between digital and social media advertising, because usually when people perceive digital, they just encompass or look at it from social or the platforms or the social media platforms only and isolated. So I'd say if you're going to be on social media channels specifically, let's say Facebook and Instagram, where you probably have a good audience locally, you're looking at least probably a gig upwards for a presence to run through maybe 3 days, give or take. So yeah, I'd say I don't want to give an exact volume of data you need, but whatever you can afford, at least maybe minimum start at a gig and then upwards. That obviously then fluctuates and differs if you then start going to having a web portal, a website, and the likes, and other forms of having a digital presence.
Speaking of the different social media platforms, I read somewhere that we live in an omni-channel era. Why is it important for small and medium enterprises or entrepreneurs to advertise in different digital platforms?
I think that's a very good question, because what then usually happens is, in some instances, as a young entrepreneur starting up, you probably then are thinking, which channel is the one that I need to be, present on? Do I need to be on every single channel because I'm trying to reach as many people as I can, and whilst also the famous, you are going to where people are. I think you need to be cognizant of what is your clientele, who you're trying to reach, and what your story or particular image you're trying to portray. So for instance, let's say you are a farmer. You then look at which platform is predominantly having people within that niche or within that space. The reason I made an example of Facebook specifically and Instagram is because locally, we all know those are the two platforms that probably have the largest community size. Obviously, TikTok is also fast growing as well. So I'd say it's important to know the kind of clientele you're looking to have, and then focusing on those specific channels that have conversations you can either tap into, an audience you can actually grow, and you have content that you can consistently churn out on those channels. The problem of being present everywhere is, one, it's guaranteed that you will not be able to churn out content across, or what will happen is you'll be copying and pasting the same content across, and it will not have the same or the ideal impact.
I am happy that you have touched on the issue of being everywhere at once, because that was going to be my next question on the dangers or challenges of being everywhere at once. But what are some of the hurdles that young people face as they use the digital platforms, and how can they overcome them?
Oh, okay. That's another good question as well. I think as an entrepreneur, I think you also need to appreciate that, as a small, medium enterprises, that we are now in an era of we are day trading attention, which then means that on these platforms, there's communities in these platforms that you are trying to have a situation whereby they either recognize or drive awareness around your product or service. That means that you are competing with entities that either have a boosting budget or have a team behind it pushing it. So being authentic, as you mentioned, usually if I'm posting something that's personal, it lands with people and people can relate with it. But then if I'm selling, usually, and let's be honest, no one goes into a channel looking to see product or trying to buy something. You then come across it as an ad, and if it's placed or plugged in a creative or witty manner, you might engage with it, but the chances are you'll probably scroll past it. So there will be that variation, but you then need to have the creativity to package or portray it in a manner that resonates with your audience. So in that part, I would say try to be authentic, which means, again, if I'm a farmer, I won't be saying I'm selling cabbages, but I'll give you value, as in, this is how ideally you would sell cabbage. Oh, by the way, my cabbages are going at that price, so that I wouldn't be like, oh, I'm getting value of it. I am willing to spend time looking at it, and then, oh, there's then the hook at the end. So try to personalize it. It's ideal to have a personality on the channel and avoid being a person who's overselling, because the moment you oversell, you lose your followers. So yeah, have that balance.
Ngiyakuva ngosivile kevakala lokuthi cha lena indzaba loyatiko impela, but I want you to talk to cultural sensitivity and using inclusive language, understanding the culture of the audience in order to maybe avoid stereotypes and misrepresentation. How important is that in advertising a business?
Again, it's integral simply because we have a situation whereby you're walking a thin line, whereby people do feel like everyone needs to be themselves and true to themselves, which is integral in that essence. But then you also do need to appreciate your audience as well. I think what usually is sometimes lost is the blurred, it's not even a blurred line, but then the lines become blurred between a personal brand and your personal page, or your company or business page, for instance, whereby people then those lines aren't distinct. So understanding your audience and understanding what you're going to turn out is not going to offend anyone, or also be inclusive to everyone that you turn out, is an integral part. As much as obviously you are also telling your personal story, you need to have that balance, because again, it is a public forum and it should never be lost in that sense.
I also did a bit of research before I came to you, because I was told you are coming to a marketing guru. So I learned about something called an optimized landing page. What is that, and how important is it if you are to advertise a business in digital platforms?
Oh, okay. That again, as I mentioned, I guess earlier, that it's also then important that digital does not entail just social media channels, which is usually that confusion of when you mention digital, someone thinks, oh, I've got a Facebook page. Digital is across. So there is an importance of being present on those digital social media platforms, but then the upside is obviously having a channel that you own. Which is yours, because again, Facebook, Instagram, TikTok, X, Threads, Discord, whichever channel you may be on, you are at the mercy of the owner of the channel. You are, in essence, quote unquote, not the landlord, but you are, renting the space. It's ideal to look at it in that manner. Now, a website is your domain. You fully own that, and you drive how I guess it's portrayed, how users experience it. So in optimizing that landing page, what you are trying to do is you are trying to ensure that whenever people come and visit it, it's clear, the user experience is seamless, I understand what you are selling, with few words needed to actually tell the story, and it's clear, whereby as well as the user interface, I'm scrolling through it, I get to, if I want to buy a service or a product, I know where I need to click through, and as well as all the information that you alluded to leading me up to that landing page is actually available. So it's mainly ensuring that the user experience when someone clicks through to your website is an ideal one, a seamless one. There's no confusion in what I see on your website.
It's been a pleasure, Ngosivile. I know that entrepreneurs and small and medium enterprise holders at home watching right now are ready to take your advice and run with it and grow their businesses. Thank you.
Thank you for staying with us. This is Nedbank Business Watch. We now want to take a look at today's financial markets. We are joined by Sandiswa Dlamini, who's the treasury dealer at Nedbank Eswatini. Sandiswa, a very good afternoon. Thank you for joining us. It has been a while. So perhaps you can start off with taking a look at currencies. It seems that the rand is appreciating against all currencies this afternoon. Take us through.
Good afternoon, Lulo, and good afternoon to all viewers at home. As you have rightfully said, the rand is actually appreciating against all three major currencies, against the USD and against the euro and the GBP. So currently we have the Fed, which we have an announcement before the end of today. We will also have the SAP, which is the South African Reserve Bank, make interest rate announcements tomorrow, and hopefully at home the CPE will announce on Friday. So the market expectation is that the rates are going to be cut, and in the US the expectation is that the cuts will be around 50 basis points or 25. So the debates are around, is it going to be 50 or 25? But in SA the expectation is that the interest rates are going to be cut at 25 basis points, whether the interest rates in the US are cut by 50 or 25. So as you can see, currently the USD is trading at 17.5545. It's coming from a point where it was at 17.70, and the euro is at 19.54. It's coming from 19.68. And the GBP is at 23.1932. It's dropped from 23.32.
Okay.
So the rand is actually appreciating against all three major currencies, and this can attribute it to a lot of factors. The fact that the SAP is going to cut interest rates at a lower pace than the Fed. There's also an improved economic outlook in SA, with load shedding being sort of non-existent at the moment, I think for the past two quarters, the second quarter and the third quarter. And the formation of the government of national unity, which have formed, which have led to investor confidence across the globe. And this led to an increase in investments. I guess in recent times, like in the news, they have announced that the investors from foreign investors have contributed to 18.6 billion in South African bonds, and this is in net basis. So currently the SA is actually doing better.
All right. So if you could move on to commodities, it seems gold has gained strength today. Are there any changes? And is there any threat to oil supply due to the storm?
Yes. So with gold, the prices of gold have been increasing actually for the past couple of months. If you look at the like the trend from March to August, and this have been because the central banks of emerging economies have been stockpiling on gold. So the demand was a bit higher, but recently these have slowed down, and the expectation is that the price of gold might end up falling. As you can see from today, for using the current data, it's 0.04 fall from yesterday. And this is because the economic outlook is that inflation have now slowed down, and so with inflation going down, the prices of gold might also follow. And in terms of oil, we also have an increase in the price of oil because there is a storm expectation in Mexico, and there's also the tensions that are in the Middle East, which are threatening the supply of oil.
Yeah, perhaps if we could quickly look through the equities. The FTSE 100 has dropped due to the release of inflation numbers in the UK. What's happening there?
Yes. So in the UK, the inflation from last month was actually 2.2%, and so the expectation was that inflation is going to fall, which will lead to the interest rate cuts. But inflation have been sticky. It stayed at 2.2, which surprised a lot of investors in the markets. So currently, the S&P 500 is currently doing well. The FTSE is the only one which is not doing so well in the indices. The JSE All Share is also doing well. This is because of the rand doing well in SA, and this is probably because of the rand is doing well because of the stable government. Investors are currently happy with the government in SA, and they are able to invest more in the economy. So South Africa is currently doing well, both economy in both in the currencies and both on their index.
All
currently.
right.
Yes.
Thank you so much, Sandy. So that was Treasury Dealer Sandy Dlamini, Treasury Dealer from Nedbank Eswatini, giving us today's financial markets. And that's it for our program today. Thank you for joining us. If it's just opened Eswatini TV, worry not, you can still watch this episode of Nedbank Business Watch on our YouTube page, Eswatini TV. We'll see you tomorrow for Market Watch.
Make better money choices. Choose a bank that takes your money seriously. Business Watch was brought to you by Nedbank.